The Federal Reserve, or the Fed, is like America's money manager. It's a big deal. Established in 1913, the Fed was created to provide the country with a safe, flexible, and stable monetary and financial system. It plays a crucial role in the nation's economy. They control the flow of money in our economy. They set interest rates, which are essentially the cost of borrowing money. By adjusting these rates, the Fed can influence economic activity. These rates affect how much it costs to borrow money. When the Fed lowers interest rates, it becomes cheaper for individuals and businesses to take out loans. Think of it like this. When rates are low, borrowing is cheap. This encourages people to buy homes, cars, and other big-ticket items. It also motivates businesses to invest in new projects and expand their operations. People take out loans for cars and houses. Businesses invest and expand. The economy heats up. This increased spending can lead to job creation and higher wages, further fueling economic growth. But when rates are high, borrowing gets expensive. This can slow down economic activity as people and businesses become more cautious about taking on debt. People and businesses tighten their belts. The economy slows down. High interest rates can lead to reduced consumer spending and lower business investment, which can result in slower economic growth or even a recession. The Fed's job is to find the sweet spot. They aim to balance the economy by adjusting interest rates to maintain steady growth without causing inflation or deflation. They want to keep the economy growing steadily. No overheating, no crashes. This involves careful monitoring of various economic indicators and making informed decisions to keep the economy on track. They meet regularly to make decisions about interest rates. These meetings are crucial as they determine the direction of the country's monetary policy, impacting everything from inflation to employment rates. Mark your calendars, folks, because January 29th is a big day. This date has been circled on many calendars for months now, and for good reason. It's the day when the Federal Reserve will make its much-anticipated announcement regarding interest rates. This decision is not just a routine update. It has the potential to impact millions of lives and businesses across the globe. The Fed will announce its latest interest rate decision. This is a pivotal moment that economists, investors, and everyday citizens have been eagerly awaiting. The Federal Reserve's decision on interest rates can set the tone for the entire financial landscape for months to come. Will they raise rates? Will they cut them? Or will they stay the course? These are the questions on everyone's minds. Each option carries its own set of consequences and will be analyzed and debated by financial experts around the world. The whole world will be watching. From Wall Street to Main Street, people will be glued to their screens waiting to see what the Fed decides. This announcement will be covered extensively by news outlets, financial analysts, and social media platforms. Why all the fuss? Because this decision will have ripple effects throughout the economy. The Federal Reserve's interest rate decision can influence borrowing costs, consumer spending, and even global trade. It's a domino effect that starts with the Fed and spreads out to touch every corner of the economy. It will affect everything from mortgages to car loans to the stock market. Home buyers might find their mortgage rates changing, car buyers could see different loan terms, and investors will be watching the stock market closely for any signs of movement. Businesses will adjust their plans based on what the Fed does. Companies might alter their investment strategies, hiring plans, and even product pricing in response to the new interest rate environment. Investors will be buying and selling like crazy. The stock market is expected to react swiftly, with traders making rapid decisions to capitalize on the new information. It's going to be wild. The atmosphere will be electric, filled with anticipation and excitement. So, stay tuned and be prepared for a day that could shape the financial future in significant ways. So, what does all this mean for you? Well, if the Fed raises interest rates, it means borrowing money will get more expensive. Your credit card payments might go up. That new car loan will cost you more each month. On the flip side, higher rates mean you'll earn more interest on your savings accounts. That's the good news. But if the Fed cuts rates, borrowing gets cheaper. You might be tempted to take out that loan you've been eyeing. Just remember, what goes down can also go up. The Fed's decisions can feel like a roller coaster ride, but don't panic. It's important to remember that these fluctuations are a normal part of the economic cycle. While it might be tempting to make hasty decisions, staying calm and collected is key. The market has its ups and downs, and reacting impulsively can often lead to regrettable choices. Instead, take a step back and assess the situation with a clear mind. Here's the deal. Stay informed. Knowledge is power, especially when it comes to your finances. Regularly check reliable financial news sources to keep up with the latest developments. This will help you make more informed decisions and avoid unnecessary surprises. Subscribing to financial newsletters or following trusted analysts on social media can also provide valuable insights. Pay attention to the news. Major economic events, policy changes, and global incidents can all impact the market. By staying updated, you can anticipate potential shifts and adjust your strategy accordingly. Remember, being proactive is better than being reactive. Talk to your financial advisor. They can provide personalized advice tailored to your specific situation. Whether it's about investments, savings, or debt management, a professional can offer guidance that aligns with your financial goals. Regular check-ins with your advisor can help you stay on track and make necessary adjustments. If you're thinking about buying a house or a car, now might be the time to lock in a good rate. Interest rates can fluctuate, and securing a favorable rate now could save you money in the long run. Do your research, compare offers, and don't hesitate to negotiate for better terms. If you have credit card debt, try to pay it down before rates potentially rise. High-interest debt can quickly become a financial burden, so prioritize paying it off. Consider consolidating your debt or transferring balances to a lower-interest card if possible. Every little bit helps in reducing your overall financial stress. And remember, the stock market doesn't always move in a straight line. It's a long-term game, and patience is crucial. Diversify your investments to spread risk and avoid putting all your eggs in one basket. This way, you can better weather the inevitable market fluctuations. There you have it. Stay informed, stay flexible, and you'll be ready to ride out whatever the Fed throws our way. By keeping a level head, seeking professional advice, and staying proactive, you can navigate the financial landscape with confidence. Remember, preparation and knowledge are your best allies in achieving financial success.